Hey everyone, welcome back to Corporate Decoder. Today we're diving into the financial reports of several Franklin Strategic Series funds. And let me tell you, this report is a mixed bag. Prepare for some surprises, some disappointments, and maybe even a little head scratching. You'll see what I mean soon enough, but first, if you like deep dives into the numbers, subscribe to the channel. Also, join our growing community on Discord. The link is in the description below. We are looking at what's called an N-CSR, which is basically a certified shareholder report. These filings are required by the Securities and Exchange Commission, or SEC, to keep investors informed about how these folks are operating. We're going to zero in on a few key reports: the Franklin Biotechnology Discovery Fund, Franklin Core Plus Bond Fund, and Franklin Growth Opportunities Fund, Franklin Natural Resources Fund, and Franklin Small Cap Growth Fund, and Franklin Growth Opportunities Fund, Franklin Natural Resources Fund, and Franklin Small Cap Growth Fund, and Franklin Small Mid Cap Growth Fund. Let's see how these funds are performing and what challenges they're facing. First up is the Franklin Biotechnology Discovery Fund, and we're looking at the Class A shares. For shareholders in Class A, the cost of a $10,000 investment last year was around $99 for the year, which is about 1.01%, which isn't too bad. But how did they perform? Well, Class A shares returned 3.64%. The main comparison that's good to keep in mind is the NASDAQ Biotechnology Index, which went up 2.36%. So basically an underperformance. What were the key contributions to the performance? Overweighting in stock selection in the healthcare services industry, while underweighting in stock selection in the life sciences tools and services industry, while underweighting in stock selection in the life care service and the healthcare services industry, while underweighting in stock selection in the life sciences tools and services industry. Not all good news. The top detractors came from stock selection and overall declines in the biotechnology industry itself. Also, the underweighting in Gilead Sciences and Alnylam Pharmaceuticals cost it. So how did it perform overall for longer period? Here, Class A shares returned about 1.93% on average over the past 10 years, so pretty mediocre growth. And with sales charges, it's even worse. 1.36% over the decade. Meanwhile, the S&P 500 delivered 12.32%, which just makes it look bad, even though the Russell 3000 index came up with something similar, 11.68%. Quick look at the key fund stats. Total net assets are a little over 707 million here, and they had 95 holdings, but that doesn't include derivatives. The portfolio turnover rate 21.87%. One thing to note is that back in September, Wendy Lam stepped down as the portfolio manager of the fund. She is no longer at the helm of this investment strategy. Next, we will dive into Class C, and the cost paid as a percentage of a $10,000 investment are 1.76% higher than the Class A shares. For the 12 months ended April 30, 2025, Class C shares of Franklin Biotechnology Discovery Fund had similar problems overall, with a return of 4.36%. Same as A compares its performance to the NASDAQ Biotechnology Index and the S&P 500 Index. Looking at the past 10 years, Class C managed only 1.119% average annual total returns, but with the sales charge, it's still 1.19% due to reasons described in the filing. Key stats are generally identical given that the fund is the same: $707 million total assets, 95 holdings, turnover of 21.87%. A lot of the same dynamics that hurt Class A also hurt Class C, and the report is identical. Same note here as before about Wendy Lam stepping down back in September, which is worth keeping in mind. Let's flip over to Class R6. Their percentage is about 0.66% for the same investment. That makes complete sense. With no load and no distribution fee, you would expect a lower number here. For ASIC shares, it still wasn't that great though, with 3.31% return during the same period. Looking at the past 10-year period, only 2.32% average annual return, so not that great either. 707 million assets and the same number of holdings and turnover rate overall. And again, nothing much changed for this fund. Finally, we'll quickly look at the materials this fund invested in overall: 96.6% in common stock and just 3.4% short-term investments. Now, let's jump into Franklin Core Plus Bond Fund, previously named Franklin Strategic Income Fund, so don't get confused. Here, Class A cost $88 for a $10,000 investment. That's an expense ratio of about 0.85%. Class A shares saw returns of 6.98% this most recent year. Top contributions came from the overweight to high-yield corporate bonds. Security selection in investment-grade corporate bonds also led to top improvements. Offsetting that, exposure to the 10-year and 20-30-year portions of the yield curve hurt performance. An underweight to agency mortgage-backed securities also was a hindrance. Over the past 10 years, Class A returned 2% annually. This compared favorably to Bloomberg US Aggregate Index, which saw returns if only 1.54%. However, Russell 3000 was much better, 11.68%, and SP 500 even more, 12.32%. Remember, past performance doesn't mean future results. Digging into the key facts, this bond fund is huge with over 2.4 billion in net assets. They have a pretty large number of holdings, 719. Again, that doesn't include most derivatives, and the turnover rate is 156%. Here, effective in December, they changed the name from the Franklin Strategic Income Fund to Core Bond Fund. They also changed the strategies. Effective November 12th, there's now a Core Plus strategy and portfolio direction. The main sectors are US government, corporates, and asset-backed. Next, it's time for the Franklin Growth Opportunities Fund. The name is exciting. How expensive is this one? About a 0.89% rate. For this, Fund A shares returned 7.85%. Not bad, but much worse than the Russell 3000 at 1140 or S&P 500. It's clear from the start it's not keeping up. Contributors from industrials and communication services sectors helped, but an underweight in Tesla was not so good, and neither was the IT stock selection. They missed some upside. Class A saw 11.08 annual returns and 10.45% with sales charges included since 2015. Not bad still, although S&P did better, so you might as well just buy the index. A massive fund here, 4.1 billion assets with 85 holdings. Turnover rate is low, 27.59%. The portfolio puts most of its weight into IT, consumer discretionary, and communication services. The material event that's happened is that they've added Anthony Hardy as the portfolio manager to the helm as of September. The performance section talks about fee waivers and expenses that boosted total return. We will focus on the cost the shares had over time. In this filing, which goes all the way to Class R6, we will skip this for now in this analysis and focus on more interesting parts. You should look to it yourself. So, what's the board approving? It's the investment management agreements. They're checking every year, and it's their job as the directors to check these things. Looking at the agreement, they'll look into every detail with their attorneys. So, we've been taking a look at numbers that are above board and certified to be accurate from fund managers. It feels like there's always some trade-off. Some funds had disappointing returns while others held the line. One thing that stood out across these reports is the recurring mention of adjustments in expenses and management. As a fund shareholder, it would be something for me to pay attention. Alright, that's our breakdown of these shareholder reports. What's your take on these numbers and what they signal for these funds moving forward? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.